Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close 30 minutes from now. Let's get to the stories you're following in the BNN Bloomberg newsroom. The federal government, as well as the government of Ontario, will invest more than $228 million over the next 3 years to protect workers in key industries. The Economic Development Minister, Patty Hajdu, says the investment will expand training and employment supports for those impacted by U.S. tariffs and global trade disruption. A wide range of workers will be eligible, including those laid off and workers seeking new skills. We're watching shares of Transat AT today. Shareholders of the Canadian airline have rejected the new slate of board members proposed by billionaire Pierre-Karl Péladeau. That proposal would have given him partial control of the board. In December, Péladeau proposed cutting the board to 6 directors, citing shareholder value destruction and a broken balance sheet. None of his nominees were elected, and investors also voted against shrinking the board. Shares of GoEasy plunging today. The alternative financial services company withdrew its 2025 outlook, 3-year forecast, and is also suspending share buybacks and dividends until further notice. GoEasy says it also expects higher delinquency reporting to continue over the coming quarters. Shares of Fairfax Financial edging higher. The company selling about half of its stake in Poseidon Corporation for just over $1.9 billion US dollars. Poseidon is the holding company for Seaspan, which owns shipyards and ferries in the U.S. Pacific Northwest. Fairfax says part of the stake will be acquired by 2 new strategic partners, and it will retain a 22% stake in Poseidon. The market's in a bit of a comeback today. The TSX moving up 57 points, taking it to 33,246 right now. And in the U.S., more of a red streak here. The S&P is down a little bit, about 0.2%. The Dow Jones down an incremental amount, and the NASDAQ only a 6-point drop so far in the day. So markets are watching, of course, the war in Iran as uncertainty continues about how long it will last and the intensity of the attacks on Iran and the response from that country. Let's go to Martin Peltier on this, Senior Portfolio Manager, Trivest Wealth, Wellington Altus Private Counsel. Thanks for joining us.
You betcha.
So oil, well off that 100-plus mark, 120 almost on the weekend. Do you see the surge being sort of more short-lived, or do you think there's a possible bounce back here?
Yeah, I mean, that's the big question here. I'll give you the best answer that's going to have the highest probability. There's going to be a lot of volatility in the next week and a half. I told in an interview last week that there was a 25% chance of oil going well over 100, and it did, but it came back down again. So there's just so many moving parts here that makes it very difficult to make near-term predictions. And therefore, you have to be very careful about how you're investing in this market. And you can see the lack of response in oil producers, and maybe even in the forward curve a little bit here, that they're not moving with spot prices. And is that the correct action to be taking? I don't know. But do I own some oil in my portfolio in case I'm wrong and these things do move higher over the longer term? Yes.
Okay, so how would you treat energy stocks more in general? Are you treating sort of oil different from natural gas, for example?
Yeah, we tend to be more, I mean, depending if you're talking about domestic gas in North America or LNG, which is a much different situation. But let's just talk about oil for a second here. There's just so many moving parts. If this, for example, if this gets prolonged and oil prices do move higher and stay higher, the economic damage that's going to be done across the board globally is very much a big risk. At the same time, if this does get resolved in short order, how much damage has already been done is the big question, and how much of global supplies have been brought on the market to deal with the spot shortage right now, and how is that going to support the long-term trend for oil fundamentals? there's just a lot of questions here. Longer term, again, I want to have a little bit of oil in my portfolio. I think we're in a commodity bull market. The commodity trend is upwards. The big question is it going to be stagflation, which is not good for the broader economy and not good for some of the other segments of the market.
Are there, Martin, right now stocks that you see as acting more stably that are perhaps a safe haven?
Yeah, I mean, we're seeing some dispersion in the markets, and that means that there's some good opportunity for stock picking. And so we're back to that again, and that's where some value can be added by your portfolio manager instead of just buying passive ETFs. You really want to think defense here. You don't want to own government bonds. That's essentially being short oil. What kind of alternatives in that space? Well, we've been using structured notes, which is beneficial. You want to own real assets. If, for example, governments have to start selling assets to pay for oil and help support their deficits, maybe they start selling U.S. Treasuries. And then that means the government's in the U.S. is going to have to find ways to support their debt issuance. And that means maybe even printing money. And that's supported for gold and even maybe some copper. So we own gold producer Agnico Eagle AEM is a good position of ours, and BHP on the copper side. And then tactically in some of the other areas, like Microsoft has been selling off. So we've reduced our Google position and rotated to Microsoft and picking away at a Honeywell, for example. So there's some good stock picking ideas in this highly tumultuous world that we're in. With
the Iranian conflict, I'm wondering if you are seeing any sort of threat yet to the data center build out. I know the data centers have been targeted by Iran and they've hit some, but do you see any sort of fallout from that, or is it too early to know?
It's too early. I mean, I think there's too many projects in the queue, and not all of them will get built anyway. And it's just a matter of, does this oil price that we're seeing on the front end move all across the spectrum and into the forward market? I mean, we're in a steep backwardation. And does that play into longer term pricing? Going back to my stagflation trade, if energy prices are that much higher, a lot of these projects are going to be very much challenged to continue. However, there's just so many of these projects in the queue. Maybe it just takes off those who are on the margin anyway, and those who have secured long-term resources around that build-out, such as copper, for example, and other silver and other metals. They're going to be able to proceed because they've hedged out some of their costs.
Okay, so talk to me a little bit more broadly about technology. We know the trade moved out of some of the Mag 7 and into some of the other more cyclical kind of stocks and equities over the past, let's say, 6 months. I'm wondering what you've noticed lately ahead of the conflict with Iran.
Yeah, and again, this is a duration trade that's unwinding. When I talk about this, it's not just duration on fixed income. It's also those who are sensitive to interest rates, because these tech companies are spending maybe even trillions of dollars, if you believe what's being put forward. And so they're going to have to depend on public markets, and they're going to depend on raising some capital and depleting their cash positions. And if interest rates go up to fight higher energy prices, higher inflationary pressures, or they even stay where they're at current levels, that means some of these projects aren't going to get built, and some of the growth numbers that are being factored into their valuations are not going to be there. And the markets are forward-looking, and so the last 6 months they've been unwinding some of that. And the big question is, how sustainable is this, and is this going to continue to play out? And that's why the short term is, and what's happening here couldn't come at a worse time, because you're seeing commodity moves across the board in precious metals, and now you're seeing it go into the energy space. And the more that this gets prolonged, it's going to, again, have an impact on rates. And so that means a continued sell-off in technology, unfortunately. But again, if it gets resolved, maybe there's a buying opportunity. And, that's why we still have some weighting to the sector, like a position in Microsoft, for example, and even some in Google.
Got it. All right, Martin, got to leave it there, sir. Thanks for your time. Martin Pelche joining us today from Tribest Wealth, the Wellington Altus Private Counsel. Anthropic is suing Washington after the Pentagon labeled the AI company a supply chain risk. We'll get into that when we come back. CBS News is reporting the American president will soon issue an executive order to remove Anthropic's technology from all agencies across the executive branch. Anthropic, of course, announced it is suing the Pentagon for banning its technology, all part of an ongoing argument and fight there. Let's go to Jim Anderson, co-founder, CEO of Beacon. He joins us to talk some more about this. Jim, is the Defense Department's ban actually impacting Anthropic's other contracts or business at this time?
Well, it's certainly affecting their federal business, and Anthropic, you can see from their statements, is worried about that. I'm not sure we're seeing it yet. Not that we would see it because they're a private company, but there's clearly a political battle at work here, and I'm not sure that the private sector companies who are using Anthropic because it's got a great product are going to be as affected.
Okay, so if Claude, which is the product you're referring to, their AI product, is deeply integrated already in the Pentagon and other executive branches of the office, how easy would it be to replace?
Not easy at all. You know, it's funny, I talk about AI a lot, and I like to say AI is bad, AI is good, AI is misunderstood, and all three of those things are true here. Obviously, this is not good for the Pentagon and the federal government. This is not good for Anthropic. And sadly, it's been a great use case in many ways about using frontier AI technology to help the Defense Department, the federal government. And then the confusing part, I think, is everybody now is sort of looking at the politics, and you look at the front line, the drones, the soldiers, the war-fighting elements of what the Pentagon does. What you're missing is the whole back end things, professional things that need to be done around logistics and effectively what amounts to office work that Anthropic is so good at, that Claude is so good at. That's going to be a big loss. It's not going to be easily replaced. As
you mentioned, the fight is really over governance, how some of these products get used in everyday conflict, because clearly it is capable of doing a lot on the battlefield. So why wasn't that stipulated at the beginning? Why is a company like Anthropic only beginning to catch up with this now?
Well, it feels like we make this mistake in technology all the time, right? I mean, it's sort of the new wave of technology. We get so excited. Robo-taxis have been in the news, right? And so, you know, there's a strong argument to be made that the technology has gotten ahead of our ability societally to understand the impact of these things. So I guess it's not surprising that this would be the same thing, because governance is messy, right? Politics is used as a pejorative term, but politics in many ways is the alternative to warfare. And we live in very polarized times, to make maybe perhaps the biggest understatement of the week. But, you know, those things are hard to resolve. So let's not let that slow down the technology, is the optimistic viewpoint. But inevitably, we see these kinds of problems crop up, and it's in many ways, it's not surprising.
How do you see this resolving itself if you do?
I see it's going to be messy, and it's going to be a compromise. I think the good news is both sides need each other, right? Anthropic certainly wants the federal government as a client, and I think the federal government, set politics aside for a second, if we can do that, very much wants and needs Anthropic. So once the sparring and the public battles sort of die down, you have to wonder if a negotiated settlement, maybe very similar to the terms that Open AI seems to have been able to come to terms with the government over, maybe that's a possibility as well. And you have to think that there's continuing conversations. The Financial Times has reported that conversations are still underway, even though the public divorce, if you will, has been announced. I think we'll have to see how that plays out in the coming weeks.
Yeah, sometimes that happens, as we know. Okay, let's talk about TikTok for a moment in Canada, because Ottawa has now signed off on the company continuing its business operations in Canada. Of course, a reversal from what an earlier decision where it wanted its Canadian operations to wrap up. Protections have to be in place. They have to enhance security. What's your take on the demands by the Canadian government, and if they're enough to protect Canadian users of TikTok?
Well, it's funny, talk about a messy political situation. This gets into geopolitics in China and the U.S. and Canada. You know, obviously lots of things. I would argue that not really very much has changed substantively with TikTok over the past 18 months. I mean, they have made some concessions. They've said that they'll allow a U.S.-based subsidiary. They've got now a Canadian agreement in place. And those, I guess, are some changes. But substantively, it's still ByteDance. It's still a Chinese-controlled company. It still has some of the most powerful algorithms in the world. So I think what's really changed is the politics, not the substance of it. And obviously the politics between the U.S. and Canada are different. The politics between the U.S. and China, and now the politics between Canada and China are different. That's arguably the much bigger change than anything substantively.
And are the security enhancements enforceable? I know that Ottawa wants a third party, for example, to overlook and oversee. Would that be enough?
I wouldn't say they're not enforceable. I would say there are scant details. We saw this when the U.S. made its accommodation with ByteDance as well. There was a strong press release say everything's been agreed to, but then very few details. How will that enforcement done? How is that accountability in place? So I would say skepticism is warranted about the details until we see and understand those details. And when those are forthcoming, I don't know.
Got it. Jim Anderson, got to leave it there. Thank you so much for your time. Appreciate it.
Thank you.
So hundreds of ships are, of course, stacking up near the Strait of Hormuz as conflict shakes the oil markets and disrupts shipping. We'll have more on the conflict in Iran and what's happening there when we come back. Ships are backed up at the Strait of Hormuz as a conflict in Iran shakes the oil markets and, of course, disrupts shipping. Renee Kofoid-Olsen, CEO of the shipping company V Group, joined our Bloomberg colleagues to discuss what he's seeing in the region as traffic in the Strait comes to a virtual standstill.
Shipping is not really quite used to these dislocations. So we have ships stations inside the cul-de-sac of the Gulf, and we have ship stations outside. If you think about the daily sort of transit on a normal day would be 140 ships. So obviously with a variety of ships, both the energy ships, but also normal bulk carriers, container ships, and so on and so forth. About 20,000 seafarers stuck.
So you're perfectly placed because of what you do to tell us what this looks like. Is it an actual closure? Is it a trickle? Are you seeing 3 or 4 ships going through every day? Are we seeing 10 or 20 ships going through every day? How does it look right now?
Right now, as a snapshot, it's closed. I mean, you have a trickle effect of ships going through, but not in any material way. Definitely you should consider it as a dislocated bottleneck.
It's a president, and to be fair, it's not just President Trump. It was Macron yesterday, too, talking about, do we get naval escorts? Trump saying that he wants to reopen the Strait of Hormuz. What would it actually take to allow the confidence to have ships be able to go through, and I guess to get the insurance to allow them to do so as well?
So if you take a step back, I think shipping is not adverse to these dislocations. We have had it in many, many ways throughout decades or even centuries. 90% of global trade is actually seaborne. It's the most efficient way of traveling goods and services on the water. But when you find bottlenecks like this, it's not that we're not resilient. It's not that we don't find solutions. The first point is the seafarers, because we don't have autonomous ships. So we need to ensure that we have a safe passage, however that is, regardless of the dislocation. So that's alpha omega. Secondarily, obviously, we need to ensure that then the assets can come all the way into their destination. And do remember, as I mentioned before, it's a cul-de-sac. And all the residents in that cul-de-sac obviously benefits from being able to have the trade flow. So there has to be found a solution for safe passage. There has to be found a solution for security going through. The strait is narrow. You have 2 lanes in and 2 lanes out. So we are waiting for a solution. In the meantime, we are ensuring that all seafarers, all ships are being looked after, waiting for what can be done. But there is not a direct replacement.
But you have, dozens of ships, thousands of seafarers that you're managing here. When you hear President Trump say, our Navy will escort you through, do you call the administration and say, okay, we've got a couple candidates here, send us the naval ships and escort us through? Or do you say, not right now, because these lives are on my hands?
So we discuss with all authorities, and we advise our clients at a minute's notice.
But it's not happening, to be clear. It's not happening right now. You're not teaming up with naval ships to go through the strait.
There is no defined structure for doing that. But historically, we have seen that. in other bottlenecks, in other dislocating places, like the Red Sea. We have historically seen a very good collaboration between Navy assets and commercial shipping. But the alpha omega for shipping right now is that there is safe passage, secure passage, and the seafarers, as we have talked about, is obviously safe.
And you probably have to know where your ships are, too. There's been reports of those clusters. They look like they're forming on the map. We had it up just a moment ago, and it might just be jammed signals showing false areas of where these ships actually are. How are you keeping track of your seafarers right now?
So obviously we are in minute-to-minute contact with our seafarers. I must say, as I just mentioned earlier, they are the most resilient parts of our industry. The craftsmanship on those ships to be able to navigate, even as you allude to, the AIS system is jammed or having a challenge coming into it. So those kind of things are obviously very, very important for all of us. But the point of the matter is that it has to be safe. And then we are, of course, in a very inflationary environment for everybody. So you are having a challenge with insurance, even though it's also a resilient industry. They are trying to find solutions for this. I think all shipping companies want to find solutions to this, to your question about Navy escorts. But right now, it's not there.
Renee, if you were to guess in a matter of days or weeks for you to start getting your ships through, could you give us a forecast?
No, I cannot give you a forecast, but I can tell you that from a supply chain disruption and from the trade flows where this is obviously omni-important for the entire world and for all the residents in that cul-de-sac. We want it to be in near term. Shipping waits for it to be in the near term. I think the shipping industry as a whole is resilient, is innovative, is creative, but that part of it is out of our hands.
All right, and in yet another twist to the conflict, CNN now reporting Iran has started to lay mines in the Strait of Hormuz, citing sources familiar with that matter. The U.S. president responded online on Truth Social, says if Iran has put out any mine to the Hormuz Strait, and we have no reports of them doing so, we want them removed immediately. If for any reason mines are placed and they are not removed forthwith, the military consequences to Iran will be at a level never seen before. If, on the other hand, they remove what may have been placed, it will be a giant step in the right direction. All right, coming up next, the closing bells on Bay Street and Wall Street. We'll take a look at oil as well at that time. We're back in a moment. Here are the closing bells for the end of the trading day. At the NASDAQ, Saki for South Asian survivors and First Bank ringing the bell. In New York, Bunge ringing the closing bell. And at the TSX, AE Fuels Corporation ringing the bell. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. Markets are up early on the day, but dropped down a little in the later afternoon. The TSX still in the green today, 81 points up, or about 0.25%. The S&P 500, a 14-point drop, so not a big drop today for the S&P, but the NASDAQ, no real material move. Ended the day up 1 point. Let's get to some of the movers in Toronto. We're going to start here with Go Easy. It is down almost 57%. That is correct after reporting loan losses. Stephanie Hughes from Bloomberg has the full rundown on that story in just a moment. Thomson Reuters down today just over 7%, so it's a $10.65 per share loss, taking Thomson Reuters to 140. A Bank of America analyst had maintained a neutral rating for the stock. That could be hitting it. Colliers International today also down close to 5%, taking the stock price to 152.07. In the green today on the TSX, G Mining Ventures gaining just under 8% today. The share price ended the day at 58.08. And then Denison Mines, also on the move, close to 6% up, 5.8. That's a gain of 30 cents a share. Let's bring in Bloomberg's equities reporter, Stephanie Hughes. She joins us now to talk some more about first, Go Easy. Stephanie, double take for viewers, seeing how much it dropped today. Walk us through what hit it.
Yeah, no kidding, Marella. Yeah, it's probably not surprising to anybody who's been watching the TSX pretty closely today that I might pick Go Easy to highlight, just given that eye-watering 60% decline at its lowest point. You showed the chart earlier, and it was just a sheer drop. Now, to put that move into perspective, that was enough to bring the stock price to its lowest level in about 6 years, and it was the biggest intraday decline since 1993. I wasn't even alive at that time, so that's how far back it's gone. So that's because the subprime lender based in Mississauga, Ontario, said it expects to write off an additional $233 million in consumer loans, interest, and fees, mostly coming from its auto and power sports equipment lending business. So the company said it expects its net charge-off rate, or the amount of money that it just doesn't expect to collect on at any given time, to be just below 13% for last year and to reach the mid-teens in 2026. That's up from a range that they had before of 7.75 to 9.75. So this really reflects a lot more pressure on consumer loans, consumers just having trouble paying back on what they borrowed, especially in the auto space. And so they end up defaulting on these loans, and the company is the one that takes the hit for it, Marella.
Okay, some of us were born in that time, but we won't get into it. Part of the problem for this company is auto loans, I understand. Can you explain?
Absolutely, yeah. So it's part of the wacky world of auto lending these days. So the losses came from LendCare's merchant network, a segment that specializes in auto and recreational vehicle loans, recreational vehicles being your ATVs, your snowmobiles, Sea-Doos, what have you. So there were weaker than expected recoveries on past due accounts. So the company had to write down on loans that it was obviously hoping to collect money on. So this is part of this has been a part of an industry-wide issue where repossession firms have just been at full capacity, and that really slows down the how quickly a lender can actually recover some collateral like a vehicle. So that when borrowers obviously miss too many payments, so that it means that the company doesn't really get the full collateral back. They don't get the money back, and I think it also shows something about the state of the auto lending industry that the repossession firms are just way too busy right now. So Go Easy is obviously hoping to turn things around, saying that it is pursuing a multi-stage business recovery strategy that includes cutting back on auto loans from LendCare and slashing $30 million in annual costs. Management will also correct an earlier financial reporting tactic process with LendCare to address some of the incorrect reporting on some of its customer payments, which they realized, or they thought they realized the payment. It didn't end up coming through before it came through, and then it didn't end up coming through. So ended up being a bit misreported. So this is all this news is working in tandem to give Go Easy its worst day since the early 90s, but the company has a plan to kind of turn that around, and they'll share more details about that when they report their fourth quarter results coming in on March 25th. So we'll have to see what comes up next, Marella.
All right, we will wait for that. Bloomberg, Stephanie Hughes, thank you for the update. Straight ahead on the show, tech major Oracle will report third quarter earnings. We'll bring you that when it comes out and break it down in a moment. Stay tuned. We have third quarter results coming in from Oracle. Let's have a look at that. Adjusted revenue for the company coming in at $17.19 billion. So it's a 22% year-over-year increase, but the estimate had been under 17 at 16.89, a beat, and that was the Bloomberg consensus. Cloud revenue coming in at $8.9 billion. So that's a 44% year-over-year increase, big number there. The estimate had been at $8.84 billion. Cloud application revenue coming in at $4 billion. That is an 11% year-over-year increase. The estimate had been the same at $4 billion. Software revenue at $6.12 billion. That's a 3% increase. The estimate had been $597, so a bit of a beat for Oracle there. Service revenue, $1.44 billion, 12% increase from last year. The estimate had been at 1.36. We're also going to stay tuned for the CapEx guidance for the next couple of years from this company. Of course, everybody watching that for Oracle, with the company taking on debt to finance its data center build out. And Ivana Delevska will also join us to take a deeper look at the numbers in just a couple of minutes. Let's talk about the price of oil, which declined today because Donald Trump, the U.S. president, had said the war in Iran is nearly ended. But of course, that was 24 hours ago. Much has changed. My next guest believes, despite the ongoing conflict, the market's stagflation fears are overblown. Let's go to Jack Evelyn, founding partner, chief investment strategist at Crescent Capital. Thanks for joining us today.
Thank you.
Why do you think the concerns about high inflation, high unemployment are overblown?
Yeah, I think the linkage between high energy prices and inflation is really disconnected. Most investors who are focused on the price surges in energy in the late 70s and early 70s miss a big evolution that's going on in the U.S. and Canadian economies, for that matter. Mostly is, we are big energy producers now here at home. So what that means is high oil prices do mean profits, at least for a segment of the market. Secondly, union labor is a lot lower than it was in the 70s, where these contracts had cost of living adjustments built in. So a high oil price could metastasize into higher wages and spiral. The third is, just like U.S. and Canada, we can now drive GDP growth with half the energy consumption that we had in previous decades. So we're not as reliant on it. And then lastly, the Federal Reserve has a lot more credibility nowadays than it did in the days of Nixon or Carter. And in those days, that there was a perception that the central bank was really behind the eight ball when it came to these adjustments. So I think for these reasons, we think that a high energy bill is going to serve more of a tax. We have increased our likelihood of recession from 20 to 25% this year, but the possibility of inflation, at least as a result of high energy prices, is, in our view, off the table.
Okay, so Jack, when was the last time there was sustained stagflation? What was happening at the time?
Sure. So we had an oil embargo from Iran in 1979, sort of bookends, if you will. And what happened at that time was, union membership accounted for nearly 40% of our workforce. And those contracts had cost of living adjustments. So when oil prices went up, inflation went up, and wages went up, and it just kept spiraling. And that was something that it took up, Paul Volcker in 1980 to finally just raise interest rates to a point that brought the entire economy into recession, but finally broke the back of inflation.
Okay, we have seen, as you know, gas prices spike across North America, even just a few days into the conflict in Iran. At what point do you worry about longer-term elevated prices right now?
Yeah, I mean, that's unfortunately the uncertainty surrounding this war. We don't know how it'll turn out and how it will end. I think that, emerging market countries, particularly China and others in Asia, rely on Middle East oil to fuel their supply. So I think we will start to see some tension build up in China and other places if this is really prolonged.
Okay, let's get to a couple of stock picks in this time of uncertainty that you like and would put some money in today. The first one is Cardinal Health. Tell me a little bit about Cardinal Health.
Sure. Cardinal Health is a consistent dividend payer and grower, not a huge dividend yield, but this is a company that enjoys a huge cash flow. And cash flow return on enterprise value is something we really focus on. So here's a company that has a 0.9 dividend yield, growing its dividend at 1%, but we think that could ramp higher. Also, we do believe that this company could be an AI beneficiary rather than an AI victim.
Okay, let's get to your next pick, which is in the defense sector, General Dynamics. What do you like about them?
Not a surprise there. General Dynamics certainly well positioned as we're involved with these incursions here. Again, high cash flow business, dividend yield of 1.8, growing at 5.7%, so well in excess of inflation, and have a long history of growing its dividend over time. Again, probably positioned very well to benefit from AI.
Okay, and Kenvue is the last one you have picked here. It's a consumer health product. So can you give me an idea of what they make?
Sure. So these are consumer products, Tylenol, other, creams, lotions, things like that, mostly over the counter, so sold in, drugstores, but also grocery stores as well. It is more of a consumer staple and did get hit as everyone was fascinated with software and digital. This is the ultimate analog product that won't be disintermediated by AI. And now that it's starting to turn, we think there's a nice trend there. Again, high quality company with strong cash flow. And
you mentioned more of the staples as opposed to discretionary.
It's more of a staples. That's right.
Got it. All right. We will leave it there. Jack Ablin is a founding partner and chief investment strategist at Crescent Capital. Thanks for joining us, Jack.
Thank you.
Coming up next, Oracle. We just brought you the earnings for the third quarter. We will digest them and talk to Ivana Deleska in just a moment. Welcome back. Let's talk about Oracle again. They reported their third quarter earnings, and we want to bring Ivana Deleska in for perspective, founder, chief investment officer at Spear Invest. Ivana, thanks for joining us. I'm going to go through a couple of the numbers we did not already have, and then we'll talk in just a moment. So Oracle's third quarter adjusted revenue coming in at $17.19 billion. The estimate had been just under that at 16.89. Cloud infrastructure, which was a key one, coming in at $4.9 billion. The estimate had been under at 4.74, and then the fourth quarter forecast, which is key, raising a total revenue guidance to $90 billion, adjusted earnings per share $1.96 to $2. The estimate had been just under $1.95. And then 2026 capital expenditure, which we know is key for 2026, $50 billion. Now, my understanding, Ivana, and correct me if I'm wrong, was the $50 billion is actually for the year ending in May, so that really isn't anything new.
That's right, Marilla. So looking at these numbers, I think overall the reported and guided numbers are better than the street, and expectations had been low going into the quarter. So it's pretty supportive of Oracle stock at this point. The big questions and concerns from investors are CapEx as we look out to 27 and 28. So that's really where we need to understand how much they're willing to spend, how much do they have secured, where are they going to find the money, who are the customers going to be. So that's really why you've seen the stock under pressure here. But in terms of fundamentals today, we know that GPUs are selling very strong, like even older generations, even older than Blackwell, like Hopper, are selling very well. So it's not surprising that the results are so strong.
Okay, so what are the numbers, or what number would be concerning to you on CapEx for 2027 and or 2028?
Well, anywhere above 70 billion would be concerning. It's not really so much the absolute number as much as it is for them to provide confidence on their customers, because basically what's going on with Oracle's business model is that they're spending the CapEx and they're hoping that they find the OpenAIs of the world, the Metas of the world to come and build on their platform. Unlike them, other companies really sign long-term agreements with this customer. So that way the business model is a lot less risky. So for us here, Oracle still looks very risky.
Yeah, they put too many eggs in one basket.
Well, that's right. Too many eggs in one basket with OpenAI. But even if you go further than that, these are big CapEx dollars, and they don't necessarily have their own internal use cases to use them for in case things come short. So, for example, companies like Microsoft, Amazon, and Google, they have a lot of internal needs. So say they overbuild a little, they can probably absorb it with their own use cases, versus Oracle needs to find new customers, and they are very levered to OpenAI.
One of the other key points we need to mention is that the company's doing this primarily on debt, right? It is going into deeper debt to try and fund the build out. I'm wondering what it has done to raise some money to pay for this build out.
Well, I think there are many ways to raise money. I think the credit markets are still open and people are willing to lend to data center projects. I think there are a lot of equity investors that may be able to partner and step in on a project by project basis. So I think the money is out there. The question is, how secure is their revenue? So I think until you see them being cash flow positive, I think people are going to have a tough time underwriting a high valuation for the stock.
Okay, let's talk about something that came out on the weekend, which was a report from Bloomberg about a change in status of a data center in the U.S., and Oracle pushed back on that. But can you explain about the build-out and what actually stalled here?
Well, I think what's going on is still not 100% clear. Bloomberg reported that the data center build-out was not happening, like that particular project was getting pushed out or canceled. That didn't appear to be the case per Oracle, so they are still going forward with it. The question is, who is going to be the end customer? So to the prior point that I mentioned, these projects are going forward, but the question is, do you have the customer secure? So I don't necessarily think that alleviates the concerns for the long run. In the short run, we're speaking to a lot of the hyperscalers. There is very strong demand. So even if OpenAI doesn't want that site anymore, it will be filled by somebody else. Meta was one that was mentioned in the news, but it could be basically anybody that needs GPU capacity because demand is very strong right now. The concern is more like, as you look out, is this a risk you want to be taking?
Okay, let's take a step back and look at the sector a little bit more widely, because I'm wondering whether the conflict in Iran, which has taken everybody's focus away from AI, whether that's going to affect any of the build-out, either in the amount of dollars available or in a timeline, do you think?
We don't see it affecting the dollars. There's definitely, as geopolitical uncertainty rises, there is more concern in the marketplace. So from investor sentiment, I think, may be affected, but the actual build-out, we're not hearing of anybody postponing projects. In fact, you really need to secure a lot of the equipment for these projects 2 to 3 years out. So the likelihood that some of these get pushed out is actually very low here. So we're not very concerned about that. But of course, geopolitics hitting the headlines, it's never a good thing for sentiment.
What's your take on the performance of some of these stocks this year and at the end of last year, because they really did come off as investors decided they were either unhappy with the CapEx spend or they were worried about return on investment and how long it would take to get there. What's your take on where the stocks and where that part of the tech sector is?
Well, what we saw as of the middle of last year is a real bifurcation within the AI trade. So it really became a stock pickers market, which is really favorable for us. So basically what you have is some companies are spending billions and billions on CapEx. It's not clear whether they're going to have the demand be there 5-10 years out. You have other companies that are providing the picks and shovels. They're making money real time. So it's actually a very interesting case on a risk-reward basis because they're not really investing a ton of money. It's all cash flow for them. So really picking where you want to be on the AI trade has really been key. And software is another one that many people expected that would be a big beneficiary of AI. And now it seems like it's actually getting hurt by AI. So I think picking where you want to be in the broader AI trade is going to be even more important as we go forward.
All right. Ivana Galeska, always good to talk to you. Thank you for joining us today. Coming up next, some Wall Street veterans are blowing the whistle on a possible market meltdown as the war in Iran continues on. More in a moment. stories we are following today. Right now, the U.S. President Donald Trump has demanded Iran move any mine it might have deployed in the Strait of Hormuz. In a post to Truth Social, Trump says the U.S. has no reports of Iran doing that, but the country would face military consequences, quote, at a level never seen before if any such mines were not removed immediately. CNN has been reporting Iran's placing mines in the key shipping route, quoting sources in American intelligence. Ottawa and Ontario investing $228 million over the next 3 years to protect workers and key industries. That's Economic Development Minister Patty Hajdu. She says it will expand training and employment supports for those impacted by American tariffs and global trade disruption. A wide range of workers will be eligible, including those laid off and workers seeking new skills. Transat AT shareholders rejecting a new slate of board members proposed by billionaire Pierre Karl Pelado. It would have given him partial control of the board. In December, Pelado proposed cutting the board to 6 directors. None of his nominees were elected, and investors voted against shrinking the board. Shares of Go Easy diving today. The alternative financial services company withdrew its 2025 outlook, 3-year forecast, and is also suspending share buybacks and dividends until further notice. Go Easy says it also expects pressure on charge-offs as well as higher delinquency reporting to continue in the coming quarters. Veteran market strategist Ed Yardeni of Yardeni Research is raising the odds of a sharp market sell-off to 35% as the war in Iran drags on. He spoke with our Bloomberg colleagues on this today.
Well, the president seems as though he's ready to declare mission accomplished or that victory is at hand. I mean, I don't know that the Iranians are acting that way. I mean, Iran's been at war with us for 47 years, and it doesn't look like they're ready to give us unconditional surrender, which was another demand of the president, and yet we're not even close to that.
So why is the market so willing to take one sentence, one news cycle, and sell oil off?
Yep.
Rather than saying, look, war makes its own momentum,
yep,
and there are 2 or 3 or
sure,
12 sides here, and we're going to continue to bid up this price.
Well, that's my concern, is the fog of war. I mean, everybody's a military expert. Nobody's a military expert. War has its own logic. And I'll turn more optimistic when I see a few tankers go through the Strait of Hormuz without getting shot at. And until that happens, I think there's still a significant risk.
You still have, though, your long-term bull call in place, right?
Yeah, I don't think this is going to last for months. I kind of agree that it could last for weeks. I think even the Iranians are strangling themselves because they can't get their oil out and they can't get whatever they import in. So at some point, there's going to have to be a ceasefire. But it's not going to be an unconditional surrender by the Iranians, as far as I can tell at this point. I mean, I'm no military expert, but I know that military historians have said that it's very hard to win a war just by dropping bombs from the air. And we're certainly not ready to put boots on the ground. The problem with this enemy is it's a terrorist state that has been beheaded, but they've got these terrorist subsidiaries that operate within Iran to keep their people at bay and also around the region. So I'd like to see that the drones stop. If the drones, the suicide drones coming out of Iran don't stop, then obviously they can pick and choose their targets in the strait. And trying to escort them is going to be a dangerous mission.
You also wrote over the weekend, I know you still have your bullish long-term outlook, but you can't roll out a bear market and even a recession. Yeah. What does that scenario look like where we get the bear market and a recession?
Well, I think we've all been kind of amazed by the resilience of the stock market here. It looked pretty bad Sunday night when the price of oil was going up to about $120 a barrel, and when you looked at futures markets, things were trading down. But it turned out the S&P 500 actually closed up. So I think there's still a lot of buying on the dips. There's still a lot of wishful thinking, and I am hopeful that this thing will be done sooner rather than later, but I need to see some evidence that that's the case, and that just doesn't seem to be the case. So I think we're still looking at something like a 10 to 15% correction. Bear market to be 20% or more, and I think we can't rule that out simply because we have a history where we've seen that oil shocks tend to cause recessions, tend to cause bear markets. Now, we did have 2022 where we had the bear market but no recession, so that's a possible scenario. I don't think this is going to be the 1970s all over again, but it's sure starting to look somewhat like it.
What do you expect the Fed to do, and where do you see rates going? Because even if we have a growth slowdown, we're looking at inflation that's still far above the Fed's target and could rise even further.
Absolutely. Well, you know, the Fed is between a ran and a hard place. I mean, you know, they've got the hard place is the labor market looks pretty weak, and if inflation wasn't a problem, they'd probably lower rates. But now you've got a mess with their dual mandate from the war, because the war is pushing up energy prices. It is pushing up gasoline prices. With a lag, we need a lot of fertilizer for the planting season, and apparently a lot of the material comes through the Strait. So there is this concern about inflation picking up instead of continuing to come down closer to 2%. So the Fed can't do much of anything, and I think even if Kevin Warsh is nominated, is approved and becomes the next Fed chair, I can't see that he's going to be able to convince anybody to lower interest rates.
His nomination is going to be really interesting, that hearing of talking about that, knowing that a president might pull it.
I want to get a ticket for that one.
I think we do. If you get us, let us be your +1, Ed. The other thing, by the way, you've been so excellent on surveillance talking about AI derangement syndrome. I've absolutely loved that. But one of the weird things about last week was software had a good week. IGV, the biggest ETF that tracks it, was up more than 7%. That flips when we get the president speaking yesterday. It's down more than 2% this morning. Does something about the fog of war and need for safety push us back towards tech, or is that something different happening there?
Well, it's an interesting notion, because back at the beginning of December, I actually recommended underweighting the Magnificent Seven, but I guess it's kind of back to the pandemic environment where the Magnificent Seven were just about the only companies that did well because they had their moats, they had their defined businesses. I made the analogy with Game of Thrones. It's like having seven kingdoms with their moats that used to kind of leave each other alone, but AI has kind of forced them into a AI arms race. And so I think tech, you got to do it selectively, and I have no problems with buying things on dips here. I have this quaint notion that corrections and bear markets are actually buying opportunities, so I have really no problem with picking things that are taking a dive. I know some people view that as trying to catch a knife, but when people start using that expression, that usually is the time to buy, to try to catch that knife.
I wonder about gold, because we saw it sell off on days when I thought people should be piling into gold as a hedge. And you've made some really prescient calls on gold. You were early to this incredible rally that we watched. Are we done here? I mean, well, is it now a speculative asset rather than a store of wealth?
Well, I think it's both still. I think it's turning out to be a good competitor for Bitcoin, for example. No, I think it's just consolidating around $5,000 an ounce.
By the way, if younger me reporting on Bitcoin at $600 had heard someone say gold could be a good competitor to Bitcoin, I would have thought the world was upside down.
Well, that's been the case for the past year or so. But no, I'm still using 6,000 by the end of the year, and I'm still using 10,000 by the end of the decade.
Wow.
So, okay, 10,000 by the end of the decade. Is this thing still the hedge for the market at the moment when you want to find somewhere that's nice and cozy to hide?
Well, I am admittedly no gold expert. I don't follow the supply and demand carefully, but when I saw it jump above 2,000 a couple of years ago, I said, I think this could be the beginning of a bull market, simply on the geopolitics of the U.S. and Europe freezing the assets of the Russian central bank. But looking ahead here, if you put on the same chart with the same scale, the S&P 500 and the price of gold, they're inversely correlated on a short-term basis. So it's a really good diversifier. On a long-term basis, they tend to have the same trend. So it's, the wealthier people get in the stock market, the more they want to diversify into other assets. That includes gold.
Yes. What is the other good diversifier to a risk portfolio right now? Bonds hasn't really given you that, considering inflation has been driving yields higher.
Well, I think there isn't a lot, so you're kind of forced to kind of grin and bear it at this point. I still think it's a long-term bull market. I still am using 7,700 in the S&P by the end of the year, and I'm still using 10,000 by the end of the decade. So I'm not giving up on my roaring 2020 scenario. It's worked out awfully well so far. We've got a few more years. Maybe this is about to be the 1970s redux, but I don't think so.
That's Ed Yardeni of Yardeni Research. Up next, gold prices moving around slightly higher today, but have remained about flat since the start of the Middle East conflict. We'll start looking at why that is when we come back. Price of gold has been fluctuating over recent days as investors shifted funds into the American dollar after the onset of the Middle East conflict. That has led to many questions about whether or not gold is still that safe haven that it traditionally is. Let's go to Helen Amos on this, Managing Director and Commodities Analyst at BMO Capital Markets. Helen, thanks for joining us today.
It's good to be here.
Can you shed some light on why we're not seeing people go to gold during a conflict like this one?
Yeah, it's a good question. I mean, what's happening at the moment is essentially that gold is showing a very tight inverse correlation to the US dollar. So when the US dollar started rising at the start of the conflict, as investors were selling emerging market currencies and currencies that were exposed to oil prices, that led to downward pressure on the gold price. Now, it was a little bit of an unintuitive move at first. We did see an initial bounce in the gold price on like safe haven demand. But really, I think, broadly, interestingly, the gold price has been behaving a little bit more like a risk asset over the last 10 days.
Okay, we were just looking at the chart. It's at about 5,200 US, I believe, today. Do you think it has bottomed out in this near term and will push up? Or what is your idea for a forecast here?
Yeah, I mean, I think, look, a lot of it depends on the pathway for the conflict. And as what you're seeing is that when the market starts pricing in sort of a near-term resolution to the conflict, you start seeing the dollar move down and then gold and other metals prices go up. And obviously no one really can predict that. One thing that we're watching really carefully, actually, is particularly ETF flows and central bank demand data. Now, ETF flows, we have kind of fairly a real-time view on, and like a lot of the retail inflows, so the ETF flows, which is largely driven by retail, actually, over the last 12 months or so, has been driven by emerging markets. And so the reason why we're looking out for that is because really the emerging markets are getting hit by higher energy prices. A lot of them are, on a stage of their development where their energy intensity of economic output is on the rise. So they're going to be very vulnerable to, sustained increases in energy prices. And that applies to retail as well as, institutional demand and sovereign demand as well. And then the other thing is, central bank demand does come out on a lag. Now, this has been a real strong story for gold over the last 2-3 years. However, the World Gold Council did report a slightly weaker month for net purchases in January. I think they reported about 5 tons of net purchases in January. That compares with a monthly average of 27 tons a month in 2025. So again, a lot of that has been driven by emerging markets. So this is something we're really keeping an eye on as one of the kind of conditions gold prices to keep rising from here.
Okay, so that's a significant drop-off that you mentioned in the buying by central banks. Do you see any reason for that? Does the central bank normally buy throughout the course of the year, or could you see a pickup in the second half of the year?
Yeah, I mean, there's an element of seasonality to it, but I have to say, like, even relative to, say, January a year ago, it looks a little bit low. Now, I think it's too soon to start extrapolating a trend from this. But, you know, we did see a couple of banks sell some gold in January. And that's not unusual. We do see that from time to time. A bit of management of their reserves. So it was reported that both Kazakhstan and Russia did sell some gold from their reserve bank holdings. But nevertheless, we are also seeing buying from a number of countries as well, like Uzbekistan, Malaysia, China, Indonesia, and Serbia. So I still think on balance, you know, the world has changed. I think emerging markets still want to keep doubling down on their diversification efforts. And definitely there's a lot of appetite to increase exposure to gold, particularly in light of like concerns over like, you know, ever rising government debt levels and this like ongoing concern over the resilience of fiat currencies. So, you know, we're not getting concerned yet, but I would say at the moment with the conflict, it might be a bit of a rocky, volatile few days or weeks or even months ahead.
The Strait of Hormuz, I know metals get moved through as well, iron ore, aluminum, that kind of thing. I'm just wondering if you see sort of that backup affecting distribution or anything on that side of things.
Yeah, we would expect it to. I mean, essentially, there's minimal close to zero traffic passing through the strait at the moment. So that's affecting any commodity that usually passes through. So it's not just, you know, oil and gas, it's metals too, and fertilizers. So on the metal side, the two commodities that we've identified that have most supply risk are actually aluminium and iron ore. On the aluminium side, the region accounts for 9% of global production, which is a huge chunk. And, you know, not just our exports of aluminium being, you know, constrained out of the strait, but also imports of raw material like alumina. And on the iron ore side, you know, we've got flows of the iron ore pellet feed going into the strait, and then pellets that usually flow out to Asian markets like China and India. And the region accounts for about 13% of global pellet supply. So we've got quite, and actually the moves in the prices of those commodities have kind of reflected that supply side exposure. They've tended to, both those commodities have kind of outperformed the complex. So I would say that's where the most supply side exposure is.
Got it. I do have to leave it there. I'm out of time with you, but thank you for your time. I appreciate you joining us on the program.
Sure, no problem.
Coming up, we'll get to some hot picks in big tech. We're back in a moment. Time now for hot picks in big tech. We were joined by Jed Ellerbrook, portfolio manager at Argent Capital Management, to discuss what he calls outstanding earnings and outlook. He started off with NVIDIA as his top pick.
I thought NVIDIA's earnings were outstanding last week. Couldn't ask for more. Stock did not respond very positively to that news, and the stock has underperformed, you know, really for 6 or 7 months now. I think the valuation is attractive. I think the company's growth prospects are really strong. Morgan Stanley had their big tech conference out in San Francisco last week, and I think the biggest takeaway for me from that event was just the overwhelming demand for computing power. NVIDIA, of course, is the primary supplier of that today. And so I think that the demand outlook, you know, looking out a couple years is really, really strong. And I think NVIDIA stock is not priced for that strength.
Isn't there a risk, though, that we'll see cancellations of these big, some of these big data centers? People will have too much debt, for example, and that could cast a shadow over the sector?
There's no doubt that their customers are spending really aggressively to buy as many of NVIDIA's systems as they can. The Amazons of the world, Meta, Microsoft, Google, Oracle, they're all spending, you know, pretty much all of their operating cash flow to build new data centers here in 2026. That aggregate spending amount is $600 billion or thereabouts. Just this morning, Applied Materials, which is a semiconductor capital equipment business, spoke at a conference, and they said they think that $600 billion number in 2026 is going to go to $700 billion in 2027. That growth, so that's a high teens growth rate. Those customers, those 4 or 5 big, CapEx spenders that I listed earlier, their cash flows are growing about, 15, 20, 25% a year. So that, $600 billion this year going to 700 next year seems reasonable to me. That is above where consensus estimates for capital expenditures sits today. And so I think that's why you see really all of those stocks I listed up here this morning.
Broadcom, another device maker you like the look of. Just remind us, where do they fit into the data center build-out, please?
Yeah, sure. Broadcom helps a lot of these big CapEx spenders I listed make their own semiconductor chips. They're not as good as NVIDIA's. They're not as powerful. They also don't consume as much energy, and they're cheaper to purchase. The big CapEx spenders, the big data center operators, Amazon, Microsoft, Meta, Google, they want NVIDIA's super powerful top-of-the-line chips, but they also want a lesser version to handle the least demanding tasks. So Broadcom really is piggybacking on top of this growth in accelerated computing capacity and the big CapEx spending plans of those big data center builders. So I'm really participating in the growth alongside NVIDIA. I don't think of them as true competitors. I think they're more, everybody's growing, everybody's participating in their growth. It's not so much what's good for NVIDIA is bad for Broadcom or vice versa.
Right. So this is they enable companies to build their own devices and kind of get out of the grip of NVIDIA to some extent. They don't just go to that company.
Yeah, diversification and balance. It's not really an acceptable situation for Microsoft and Meta and Google and Microsoft to be so exceptionally dependent on one key supplier, NVIDIA in this case. They need other options. And the best second option is partnering with a Broadcom or Marvell to design their own less powerful chips.
We're awaiting the latest CapEx forecast for Microsoft. That's your final idea. What draws you to Microsoft right now?
Yeah, Microsoft stock has been beaten up because of this software sell-off that's been going on over the last 6 months. I think investors have been shooting first and asking questions later with regards to virtually all software stocks over the last 6 months. Microsoft has been caught up in that, even though yes, Microsoft offers a whole lot of software to customers, but they also have a really large cloud computing business and other businesses in their corporate umbrella. So I think Microsoft is an attractively valued stock today. I think their competitive position, both in software and cloud computing, are very strong. And so I think, we think that stock is an attractive candidate for purchase here today. Just one more mention, maybe. Oracle reports earnings tonight. They are going to give us a view on CapEx spending as well. They recently upgraded their capital expenditure forecast from $35 billion to $50. We might get another update to that here this evening.
People are a bit worried about Oracle, though, aren't they, in the debt load and whether they could be overdoing it?
Yeah, what's unique about Oracle, I mentioned that most of these companies are spending all of their operating cash flows to build data centers. Oracle's gone beyond that. They're spending more than all of their annual cash flows. They have a fairly high debt load, about 4 times EBITDA, and so they're the most kind of leveraged, the most aggressively financed of these data center builders. And investors are skeptical of that and concerned about it. There's so much about AI that's unprecedented and unknown. Sure. When you stack leverage on top of that, investors are worried.
And would you be a buyer of Oracle right now?
We own a small position of Oracle in our Argent Dividend Select strategy, but it's a small position for us.
Jed Ellerbrook, their portfolio manager at Argent Capital Management. Okay, let's have a recap of where the markets ended the day, or at least the TSX. It did gain back some after being thrown around a little bit by the price of oil for the past week or so. 81.33 points up today, about 0.25%, and ending the day at 33,270. The American markets were pretty flat today, so they ended up in the red marginally. Let's get to the price of oil, which has whipsawed around. Today, it is down $8.36 to $86.41. Remember, only on the weekend and early on Monday, it was hovering around $1.19 a barrel because of what's going on in Iran. Know Your Options is coming back. Tune in tomorrow at 3 p.m. Eastern to have your options trading questions answered by Chris Tom. And thanks for joining us today on The Close. We'll see you back here tomorrow.